All right. Thanks again, everyone, for joining us tonight. We know and appreciate that you have a lot of demands on your time, and appreciate you choosing to spend it with us this evening as we present Flintridge Apartments, our newest investment opportunity. It's 188 units in Arlington, Texas, and so those of you that have been investing with us for a little while know that we've recently, in the past 6 months or so, had a couple pretty successful exits of properties that we acquired in 2021 timeframe and arguably at the higher end of the market. And so, here we are in a very different part of the cycle, much lower into the market at the moment, and have opportunities that a couple of years ago, were kind of a dream for us as investors to come along. And we have the opportunity right now to capitalize on one, which I think is a prime example here this evening with Flintridge Apartments. So we're going to go through this deck and we'll share some stuff with you and do a Q&A at the end. And if you should have a Q&A box at the bottom. So if you have questions as we go through this, you can either hold them till we get to that point, or feel free to drop them in there. If we have an opportunity to answer them in the chat, we will. Otherwise, we'll address them out loud as we get to the into the presentation. So disclaimer, I'm not going to read this word for word to you. Just a couple things, to mention. There is inherent risk in real estate investing, as there is in any investments. So we encourage you to do your own due diligence, read the material. The private placement memorandum operating agreement are available in the portal. So you can look at the merits and risks before making your decision. We are offering this as a 506B. So it is available to accredited and sophisticated investors with a prior existing relationship with myself or one of the other sponsors. It's just a quick table of contents here. I'll do a high-level executive summary, introduce the sponsorship team, talk a little bit about the market, dive in a little bit deeper into the property as well as our financial analysis. And finally, at the end, I'll give some next steps for those that are potentially interested in investing, as well as open it up for Q&A. So executive summary. So Flintridge Apartments is a 188 unit garden style community in North Arlington, submarket of Dallas Fort Worth. For those not familiar with Dallas Fort Worth, Arlington sits pretty much central between Dallas and Fort Worth. You'll see in a few slides, it's a mile or two. This particular property is a mile or two north of AT&T Stadium, right where the Cowboys play, as well as the Rangers, that kind of area. It's actually about probably 15 or 20 minutes, this property, from my partner, Jonathan, who's on the call with us tonight and lives in the Arlington area as well. This particular property, 1979 construction, unfortunately for previous owners, was foreclosed on last August by the lender. It's currently being managed by the lender that foreclosed on it and who we are acquiring it from. You'll see that it's currently at 78% occupancy. And so really our business plan here is the stabilization, getting that up 90+% occupied and running it in stabilized operations, more so than large rent increases. So we're buying at a very attractive basis, which you'll see here shortly, doing that, getting the occupancy up. And the average current rent, average performer rent that I'd like to highlight there is really only $13 difference, right? And so I think what that shows is our business plan doesn't depend on us going in and making large rent increases. It's more about the marketing, getting the occupancy up and then stabilized, which in our opinion in the current market is less risky than if we had a plan that required, $150 or $200 rent increases. So some investment highlights. There's a number of reasons that we as the general partners are really excited about Flintridge. I'm going to give you some high level ones here, and then I think as we go through the slides, we'll provide some additional detail that kind of supports these. And so the first one is the attractive basis, as I mentioned. So the previous owners acquired Flintridge for $140,000 per door. They went on to spend about another $20,000 per door in upgrades for a total of 160,000 per door investment. We're actually acquiring this for $106,000 per unit, so well below that peak pricing. And then later on, we'll also show you that we think it's well below even more recent and current sales as well. We've also negotiated seller financing from the lender that we are acquiring the property from. And so Jonathan will talk a little bit about some of the details of those loan terms a little bit later, but they're very attractive terms that we would not be able to find on the open market today. I've kind of already mentioned the operational upside is really through stabilization rather than large increases. And then finally, the prime DFW location. And so again, those that have invested with us for a few years know that we've acquired a number of property in tertiary markets in Texas. For a while, DFW, Jonathan has been there in Arlington since we worked together over the last 5 years, and it was just a little bit too aggressive, perhaps, on the pricing that we wanted to be in. And over the past year or so, that has shifted and changed, and we've actually been able to acquire a couple of properties in the MSA. Projected returns, we'll dive a little bit deeper into that, but similar to the last couple opportunities that we've had, we have a couple of classes available depending on if you prefer a $50,000 or $100,000 minimum. Slightly better economics on the $100,000 minimum, but we'll go through that here shortly. And then finally, as we do on all our properties, we will be performing a cost segregation study, taking advantage of the 100% bonus depreciation in 2026. And so we have already got some estimates on that study. Of course, we have to do the final one, but currently those estimates come in at 83% of the investment, could potentially be up right off. And so as an example, if you invest in Class B at 100,000, the current estimates would show an $83,000 write-off allocated to that. So we're not tax professionals necessarily, and we all have different tax situations. So I encourage you to talk to your tax professional on how that does or does not benefit you, but we will be doing that cost segregation study. And then finally, I think like most things in life and stuff, the team is incredibly important, and we could present the most optimal uh, deal, and if you don't have the right team and the right people in place to execute, then you probably won't. And we'll show you after the talking about the team some of the track record and things that we've done over the past few years, but we think we have a great team in place. I'm not going to spend a lot of time introducing myself. I've invited pretty much everyone here that's on the call tonight, but I would like to introduce my partner, Jonathan Nichols, who's on the call with us. We've worked on this will be our ninth property together in the last 5 years. So, Jonathan, if you want to introduce yourself and the rest of the team.
Yeah, absolutely. Thanks, Marcus. First of all, excited to be doing another project alongside Marcus. Probably many of you on this call have invested in other projects that Marcus and our company Apogee have done together, which is quite a few on the next slide that we'll talk about in regards to track record. And so many of you may know me. My wife Paula and I, we live in the Dallas-Fort Worth area. I'm a former aerospace engineer. She is a former management consultant, and together we started investing in real estate and formed our company Apogee Capital, which buys multifamily assets like Flintridge across Texas and Oklahoma. And so partnered on a number of deals with Marcus. Two of them actually went full cycle within the last 6 months and have done very well, as Marcus will speak to in a couple minutes. But excited to be partnered with him on another deal. Just to give you a highlight of a couple of other general partners who are on our team. First of all, the Westline team here, which is Kevin, Ryan, and Garrett, who's on the next page. They're friends of mine. They live out in LA area of California. And, Ryan specifically has been in the multifamily business for many years, owns a lot of assets out in LA. And they are actually putting a very large 1031 into this project. And so excited about that. We'll talk about that a little bit later. And then a few other partners, some of them that may seem familiar if you've been on our other projects. Dan, another California guy who works for a family office doing real estate investments for them, partnering with us on this project. Vijay, who's been a partner with us on a couple different deals, namely Radius and Townhouse. And then a newer partner, Jeff, who's joining us for this deal as well. Back to you, Marcus.
All right, thanks, Jonathan. Yeah, so as Jonathan mentioned, just kind of want to share some of the track record and work that we've done together. Flintridge is the ninth one, as I mentioned, working with Jonathan and Paula over the last 5 years. And so this track record slide actually represents Apogee Capital's track record, which is Jonathan and Paula, because they are our primary asset managers down in the Texas, and I have partnered with them on all of these properties, with the exception of Sunscape and Slate Apartments that you see kind of towards the bottom. We mentioned two exits that we've had over the past few months. So Sierra Condos towards the top, and Asher, which was a smaller joint venture that we did together. And so both of those, excited to, say that we exceeded our 5 year projections in 4.5 years for each of those respectively. And in addition to those recent successful exits, I just highlight the increase in NOI over on the right-hand column. And this is important because, with our multifamily properties, the an increase in NOI is, an increase in the value of the property, independent of what the market is specifically doing. And the NOI is something that we as the general partners can control from our efforts. And I think this kind of shows, over the past few years that we've been pretty successful in doing so, including properties that we bought, as you can see, starting in 2021 up to today. So through even some of the higher points in the market. I'll transition and talk a little bit about DFW and Arlington. So I'm not going to go into a lot of detail on the market specific, but Dallas Fort Worth, if you're not familiar with it, it shows up a lot on recent charts as the number one multifamily market in the country. And like I said before, like Jonathan has lived there since we have been working together. We've kept a close eye on it. We decided to invest in tertiary markets for a period of time just because of how aggressive it was there in DFW. And that has shifted. And we have started to see, opportunities like Flintridge and Townhouse that's not too far south there to present themselves in recent months. And so we're excited to have the opportunity to invest in that area. Some of the things, the metrics and stuff that we do like about Dallas Fort Worth MSA is the population growth, the labor market growth and diversification, and then certainly some landlord friendly policies as well. As we dive into Arlington a little bit more, as I mentioned, this property is just a mile or two north of the stadiums there, a 15, 20-minute drive from Jonathan. And it's right there central between Dallas and Fort Worth, very affordable. And what I want to highlight on this chart is the affordability factor about halfway down. And so what we're showing here is, the talk about not spending more than 33% or about a third of household income on housing. And so taking into account the median monthly household income just above that, so in the 1 mile radius, you're looking at the 4661, that 33% is a little over $1,500 per month. Our pro forma rents are just over 1,800. So there's like a $420 gap. And that increases as you go into the 2 and 5 mile radius. So this is just essentially demonstrating that our pro forma rents are very feasible and affordable in this particular market. And finally, as I go into the rent comparable, so we have three there. We chose these for a couple of reasons. Number one, all of these three have either sold or are under contract recently. And so you'll see these again as our sales comps as well. Additionally, one of them is a neighboring property. The other two are within a mile. They all have a very similar vintage, as well as the average unit size. And what I'll highlight is all three of them are 90+% occupied, and their rents are, anywhere from 95 to, quite a bit higher, a couple $100 higher than ours. So showing the potential to get to the 90+% occupancy. And even though the rent increase isn't necessarily a basic part of our business plan, it's more of the stabilization on the occupancy. There's certainly some potential there to do so. And with that, I'm going to turn it over to Jonathan to dive a little bit deeper into the property.
Awesome. So I'm going to talk a little bit about our property and then some of the financial overview. Marcus has already touched on a couple of these points. But first of all, we have a really nice unit mix here. You see, we have some one beds, some two beds. I would say in this particular submarket, they're likely equally desirable. We have a lot of young professionals and such that live in Dallas Fort Worth area and Arlington. One floor plan that I like in particular, the middle one, I have it labeled as a 1.5 bed because it's actually almost like a two bedroom. It's just the second bedroom doesn't have a closet. And so it's officially a one bed, but great area for like a study or, even a second bedroom for maybe a single parent. Just a lot of great options there for people that are wanting to come in and rent. And so let's go ahead and jump to the next one, Marcus. And so to talk a little bit more about just like the physical features of the property, even though it's a 1979 build, I would say this property really presents itself a lot more like a 1980s property, which is really what we prefer at Apogee at this point. When you go from the 1970s vintage assets up to the 1980s, you really eliminate a lot of the physical problems that you have on properties. So, for example, it's not listed on this slide, but we have PVC sewer lines. Huge difference between that and replacing a lot of cast iron on properties that's typical in the 70s and older vintage deals. Obviously, slab foundation, which is normal for most properties. Pitched roofs usually last a lot longer, easier to maintain than flat roofs. Asphalt parking lot. Individual HVACs, that's something that we always like on all of our properties. And then, although we have a boiler which provides hot water to all the property, we actually had that inspected as a part of our due diligence. It's currently in good shape. So excited about that. Next slide. Community amenities. First of all, my favorite is the swimming pool. You can probably see from this picture, it's like two levels, has a waterfall going down. Really a nice amenity for an asset in this particular submarket in this vintage. The broker referred to it as a resort style pool. I kind of like that terminology. So nice swimming pool. We do have a laundry center on the property. All of the units, except for the smallest one beds, actually have washer dryer connections. But for those smaller one beds, as well as anyone else who just, for whatever reason, doesn't want to bring a washer dryer to their apartment, we do have the laundry center. A dog park, and I would say a very nice dog park compared to a lot of them that I've seen. Grilling picnic area, which you can kind of see in the back of the swimming pool. And then, of course, with our property manager, typical on-site maintenance, 24-hour maintenance that you would expect on an asset of this size. Next slide. So unit layouts, I'm not going to spend a whole lot of time here other than to say these are pretty large floor plans, both for one beds and two beds. Your largest one bed is almost 800 square feet. That's a typical size for a two bed. And then, your largest two bed is well over 1,000. And they do feel rather spacious when you walk in there. And so I think the builders of this community really did a great job and constructed floor plans that people actually want as opposed to the ones that are just the most space efficient. And so I think that's a huge selling point for residents when they come to tour our property. Next slide. Unit interior. So I believe Marcus already mentioned this, but the previous owners spent about 20K per unit, most of which went to interior upgrades. And so obviously, as a part of our due diligence process, we walk all of the units and confirm that they are all indeed upgraded to this level. And so what you see here in these pictures is literally what you get in all the units. And that is not typical of multifamily investing. Usually you have a bit of a smorgasbord of unit interior renovations, but you see the nice vinyl flooring in the common areas, carpet in the bedrooms, newer cabinet faces, stainless appliances, quartz countertops. Truthfully, this is an upgrade that for a B minus, C plus property, depending how you look at it, is really a bit of an overkill. As in, Marcus and I would likely not go into a C class asset and spend this money on it ourselves. But because we're getting it at such a good discount and it's already done, it's a huge selling point for potential residents moving forward. And so, something that we're really excited about on this particular property. Next slide. So comparable sales, you'll notice here that these are the exact same properties that Marcus spoke to on the rent comp slide. That's intentional, just so you can have apples to kind of look at. There's actually a handful of other properties that have sold in this community over the last couple of years, and you have similar numbers to what you see here. And you'll notice that our contract price at 106 a door is substantially lower than any of the other sales that you see here on the chart. And so, we mentioned early on in the presentation, hey, we're buying this at a huge discount to top of the market in 2021, 2022. That's great. But, of course, the real question is, are we buying it at a good price today? And my opinion is that you look at these three comps as well as some of the others, and I would say we're getting it at a very fair price for the market today, not even considering all the upgrades that I mentioned on the property that have already been completed. Next slide. Property management. So, Richmark, you're welcome to read through the whole bio here if you so wish to. They're the same property management group that we use for townhouse apartments. Perhaps some of you here are familiar or are investors in that project. We took that property over, also a DFW asset, 1980s DFW asset in Ennis, Texas. We took it over on December 31st of last year. It was 91% occupied at the time of takeover. And by the time we reached March 1st, we were 96% occupied and 98% leased on that asset. And I would give almost all of the credit for that to our property manager, Richmark Properties. They really do a great job. They're definitely one of the top property managers that we've worked with. If you've been on a number of our other projects, we have various third-party managers that we've used across, various markets, and they're definitely near the top, if not the top of the list. And so excited to work with them on another project. Just one kind of interesting fun fact. One of the founders of Richmark, Sandra, that you see her bio here, when I told her we were under contract to buy this, she got super excited and told me, she's like, Jonathan, 25, 30 years ago, when I first started as a leasing agent, this is the first property that I ever worked at. And so you have to let me manage it. And I told her, I was like, well, you're definitely in the top five, so we'll have a conversation. But of course, because they've done such a great job at Townhouse, we were happy to award them the opportunity to work on this property with us as well. Next slide. All right, now we'll jump a little bit more to the financial analysis instead of just the property. So some of this Marcus is already covered in terms of the Class A and Class B shares, but for anyone that's not familiar, our average investment on these deals is usually a little north of 100K. We do allow sophisticated investors and we do allow minimums down to 50,000. But we give a little bit better economies for investors that want to invest a minimum of 100. So you can see the splits, the preferred return, et cetera, that we're projecting here. Notice this is over a 7-year hold time. And that's because, as we'll discuss in future slides, we plan to hold the property under the seller finance for 2 to 3 years, refinance into a 5-year fixed rate agency loan product, and then sell around the 7-year mark. Frankly, in today's real estate investing environment, these types of slightly longer business plans just make the most sense. Obviously, you can always try to exit the project early if you've already hit projections. We did that on Sierra a year ago, as Marcus mentioned, but we want to try to give estimates that are conservative and that we believe are reasonable given the current investing environment. So, one of the things I really want to touch on this slide is you look at the capital stack on the left-hand side. You see, obviously, we're getting 17 million or 85% of the balance from our lender. And then we have another 4.5 million, which is for our down payment, our CapEx, our closing costs, etc. One of the questions that we always get from limited partners is, how much are you, as the general partnership team, investing in this deal? Well, on Flintridge Apartments, because we truly believe this is once in a real estate cycle opportunity, one of our partners from Westline is actually doing a $2 million 1031. And then right before this webinar, I was tallying the current other GP investments, which come up to around 700,000. And so 2.7 million out of the 4.5 is actually coming from the general partners. And so this is hands down the largest general partnership investment we have ever made on a deal. And so we're really excited about that. And, definitely shows that we're bought into this project and want to see it through to be successful. But the other side of the coin here is that it mentions we have pretty limited space for limited partners, a little under $2 million. And so if you're listening to this and you're interested, I always encourage you take the time to review the deck, ask your questions to Marcus, to myself, but then make a decision and invest because I don't think that this opportunity is going to last very long given those economics. And once again, we as a general partnership team are just really excited about this particular deal. Next slide. So let's jump into just a little bit of the business plan. I know Marcus touched high level a few of these things. On the right, we'll start with that. You can see our CapEx table. And so many of you may be saying, why are you bringing $700,000 to a deal that already has all the interiors upgraded? And the short answer is that multifamily assets are always using CapEx dollars. Even if you have all the units renovated, there's always something that needs to be fixed across the property. And so we did an extremely thorough due diligence process on this project early on. And these are the conservative estimates for what we think we're going to need for various projects. And just to touch on one or two of them, and then if you have questions, happy to answer it in the Q&A. We do always bring money for unit interiors. Unfortunately, tenants do break things, and you need to have money ongoing to upgrade units that you've already upgraded. And so that's why we have the $150,000 at the top. Obviously, older properties, you're going to have HVAC replacements. We do have some exterior repairs that were identified. And then the parking lot and roof, although they're in good condition right now, we do anticipate having to do some repairs throughout the business plan. And so that's why we have all these funds labeled here. And so while it might seem like a large amount to you as a passive investor, this is actually, a needed CapEx to bring to be safe with the project, make sure that we're taking care of the property correctly. Jumping back to the business plan on the left side of the chart, I think a couple of the things I really want to highlight here. One, operational stabilization. It's kind of a mouthful. The property is currently 78% occupied. It was well over 90% prior to August of last year when the lender foreclosed. As Marcus mentioned, the lender essentially took over the deal. They live in Utah or their business is in Utah. And they said, we can run this thing from Utah. Turns out they are not able to do that, hence why they're selling to us quickly and at such a discount. But perhaps for some of you who maybe are not as familiar with these types of assets, the 78% could be concerning. And so I just want to address that, like we at Apogee, particularly our asset management team, Paula, our property manager, we have a tremendous amount of experience in a successful track record turning around properties that are much worse than this. So Parkside Apartments that Marcus might have spoke to a little bit earlier on our track record slide, we took that over at 65% occupied with literally over a dozen down units. We're taking this over with less than half of that gap to get it to 90% in a much stronger market, arguably with a better property manager as well. Additionally, one thing I would highlight is I myself do a little bit of third-party asset management consulting for a couple of our key investors. And so I actually have a project right around the corner from this that I took over a year ago. I'm not able to disclose the name or specific details, but we took it over also at 65% occupancy, $35,000 of delinquency for a 108 unit project. And now 1 year later, we're sitting at 92% occupancy and we're closing out April at $70 of delinquency, which is absolutely incredible. And so all that to say, we as a team are very experienced with this kind of business plan. We know what we're getting into and we're well prepared to get this thing over 90 sooner rather than later. A couple other things I want to touch on here because I think it's important, the refinance. Also, if you look at Parkside as an example, we try to be very conservative on our projections for refinance because it's somewhat speculative in nature. We don't know exactly where interest rates are going to be, cap rates are going to be in 2 or 3 years. So we try to be conservative and use pretty similar numbers to what we see in the market today. On Parkside, we projected around 20% of capital being returned to investors at the 24-month mark. But instead, we were able to return 60% of capital at the refinance at the 17-month mark. Now, that's that project. This projection is, of course, 10% at the 2 to 3 year mark, but just want to say that we do try to be very cautious with those projections. And then finally, we intend to sell the property around 7 years, so 7 year hold time, at around 28 million or 148,000 per door. As a reminder, the previous owners purchased this property 5 years ago at 140,000 a door. And so we think selling at 148 12 years later is an extremely reasonable projections when you look at some of the trend lines and such. Um, Finally, additional income opportunities. We always like to have things that we identify during our walks, our due diligence is like icing on the cake. So all that means is that we have not accounted for these opportunities in our underwriting, but we do believe they are achievable and are going to try to implement them into our business plan. So specifically technology package, this is where we go in and add like a smart thermostat, a ring camera, and a smart lock for residents to use. These features are not only great for the residents and produce other income, they're also great for our property management company as it makes it easier to manage units. For example, like adjusting thermostats when it gets cold outside. And then also looking at adding some carports, which are not currently on the property, and leasing additional washer dryer sets, of which a few units have already been leased. Next slide. Debt overview. So early on this project, this deal was brought to me off market from one of my broker relationships here in Dallas Fort Worth, and essentially it was under contract with another buyer who's out of state, and they were not comfortable executing this type of business plan from out of state, whereas obviously we were. So the broker came to me and said, "Jonathan, I think this guy's going to fall out of contract. Can you get a backup offer in place?" And I was like, "Well, I can, but I'm at a lower purchase price and I need more leverage on the seller finance." And so we were able to get the seller to accommodate both of those requests and wound up with a note, a seller finance note from this particular lender for $17 million. Dollars. That's approximately 85% loan to value for what we're purchasing the property at, a fixed interest rate. Probably many of you are aware of how valuable fixed interest is for a 3-year term, all interest only. And so, as Marcus already mentioned, this is a debt terms that you could not absolutely get on the market today, the open market for a deal. We're simply getting it because the lender trusts us to take over this asset, to turn it around, and to reduce the amount they have to short sell on the property. Next slide. So, quick financial overview. I'm not going to highlight too much on this slide other than the bottom right-hand side, some of our key assumptions. Dallas Fort Worth has been pretty flat on rent growth the last year or two, and we've continued to model 0% rent growth for the first year of our business plan, pretty modest rent growth the second year, and then a little bit under market norm for the remaining years of the business plan. This averages out to about 2.75, whereas historically Dallas Fort Worth has seen closer to 4% in recent years. And then our exit cap rate of 6%. So obviously, when you're buying something distressed like this, entry cap rate is somewhat irrelevant because the numbers are skewed due to an artificially lower NOI. But if you look at like CoStar reports, for example, today cap rates are suggested to be in this submarket around 5.7 to 5.8. We're going ahead and bumping that up to a 6% cap rate. And just as a point of reference, back in 2021, 22, at the height of the market, an asset like this would have sold around probably 4.25% cap rate. So trying to be very conservative on our rent growth, very conservative on our cap rate, and we'll show some sensitivities here in a couple charts that are also useful. Next slide. Investment projections. And so this is basically just overall what we expect for the property each year as far as income, as far as expenses, and resulting cash flow NOI. A couple things I'll highlight here. We've been pretty conservative on expenses. If you go about 2/3 of the way down, you see the expense ratio. We start out about 56%. We level off or stabilize around 50%. That's generally considered pretty conservative for an asset like this. You also notice on years 1, 2, 3, we've been really conservative on our economic vacancy, giving us the time to stabilize this project as well. I think that's all I wanted to highlight here. We can go to the next slide. And then everyone's favorite projected investor return. So we have charts for both Class A and Class B shares on this project. You'll notice we are projecting no cash flow year one on this project. And I want to highlight that just so that we're very transparent. Normally on our projects that are stabilized, we'll start distributions around 6 months into the business plan. That's what we projected, for example, on Townhouse. And yay, verily, we are planning to start those distributions here in about a month in June. But for this project, we needed to have time to get it stabilized. And so we want to allow ourselves a little extra time. And so plan to begin distributions around the 12-month mark. You can see specific amounts that we're projecting for years 2 through 7 on the cash flow and what that is percentage wise. Our refinance, as you'll see at year 3, is projected at 10% of your capital being returned to you that you're investing in the deal. And then obviously the rest of the capital is being returned at the time of sell or year 7, along with the profits and the totals for the investment return. Next slide. So, as an engineer, one of my favorite charts is always the sensitivity study. And essentially, what this means is that, on these analyses, we make some pretty important assumptions. And I think cap rate and rent growth are two of the most important assumptions that we make. And so, you as an investor, if you're sophisticated, you may have some differing opinions or simply just want to see that if we are incorrect on the assumptions, one way or the other, what will your resulting returns be? And so, here on this chart, that's exactly what it shows. I kind of gave you an overview of what cap rates were going back a few years ago, why we think they are where they are. But if they're a little bit higher than what we're expecting, you can see that the returns are still pretty strong for this investment, even up on the higher end. And if they're lower, which is still far above what they were a few years ago, you can see that the returns just get that much better for you as an investor. And then I believe next slide, I'm handing it back to Marcus.
Thanks, Jonathan. Got to figure out how to turn my video back on. Yeah, so we'll just jump into some next steps for those that might be interested in investing alongside us in Flintridge. So a few things, investment criteria. So as I mentioned, this is a 506B. It is open for sophisticated and accredited investors that have a prior existing relationship with myself, Jonathan, or someone else on the team, the sponsorship team. As we've mentioned, we encourage you to review all the materials carefully, the PPM operating agreement and such. A copy of these slides are all in the portal that you can review. We encourage you only to invest funds that are not needed for liquidity. And so, as you know, our business plan is, longer term, like 7 years. And so if you need funds to buy a house in 2 years or send your child to college in 3 years or something like that, perhaps this isn't the best investment opportunity for you. So we do project distributions. And as Jonathan mentioned, maybe a small return of capital when we refinance, but for the majority of the investment, it is illiquid for the duration of the investment. And finally, while you as an LP are generally pretty passive, the one action that we do ask you to take is to read monthly investor updates carefully. The team works hard on the property to execute, and we try to translate that through monthly updates, what's happening. And if you decide to invest, we just encourage you and ask that you read those. And if you have questions that we haven't answered, we're always available to answer those for you. Finally, timeline, or April 30th, we're doing a webinar this evening right here. May 11th, subscriptions due. As Jonathan mentioned, due to the amount that the general partners are investing, there is a limited amount of space for limited partners and passive investors. So if you decide to, it is on a first come, first served basis. I encourage you to sign those sooner than later so we don't miss out on that opportunity. And we ask that you send your funds, in a reasonable amount of time after signing that. We have a May 22nd deadline in anticipation of a May 28th closing. So we're about a month away. And as you know, as I mentioned, I invite everyone on the call here tonight. You're welcome to reach out to me if you want to talk to Jonathan. He always makes himself available as well. And a couple post-closing things for those that do decide to invest. You have access to our investor portal where all the documents are available. That's where your K1s will be, performance metrics. Once we do start distributions, which as mentioned is not anticipated in the first year on this particular project, but once we do start quarterly distributions, those are initiated through the portal via ACH. And finally, as I mentioned, we do provide monthly updates and try to be responsive to any questions that might come up as well. Another disclaimer, if you are having trouble sleeping tonight, then you can read that. I'll let you, it's available in the investor portal. And I'll leave this up for just a moment. QR code will go to the portal where you can review the documents and or submit your investments as well as the link up there. I'll leave that there for a second and then we'll stop sharing as we go into Q&A.
Cool. Guys, if you want to submit a question, and a couple of you already have, there's a box at the bottom of your toolbar. It says Q&A. That's the best spot to submit your questions. And we actually already have a couple of them that have come in. And so I'll read them off and let Marcus answer or myself. First question, is Arlington still growing?
Yeah, I mean, Jonathan, maybe I'll speak to this better than me because he's right there. But from the data that I look at, it's been about I think 3 to 4% increase since the 2020 census over the last 6 years, and so certainly that's Arlington specific. The DFW market around there may be a little bit different. I don't know if you have any other input on that, Jonathan.
Yeah, so I'd say first of all, the traffic definitely feels like it's still growing. But in all seriousness, we have several things that are going on in Arlington. Obviously, DFW as a whole, which includes Arlington, is continuing to grow rapidly in population growth, in job growth, etc. Just to mention a couple things that are kind of interesting, obviously we have the entertainment district in Arlington, so that's like your Six Flags, your AT&T Stadium where the Cowboys play, your Rangers baseball, and then just a number of other things. And that area, which is only about a mile south of our property, has just blown up over the last 6 to 8 years. We have a new stadium for the Rangers. We have a couple very large, well-known hotels that have built and then built another hotel all in that area. And so there's a lot of money, a lot of investment going in this area, independent of housing. And so I think that there's, a lot to say for Arlington as a submarket. It has been softer the last year or two, and that's true of all of DFW. I mentioned kind of the flat rent growth that we've seen. And that's quite frankly the reason why we're able to get properties like Townhouse, like Arlington or Flintridge in Arlington at such a good price, is because we're at or near the bottom of the market. And so we couldn't find these kind of deals going back 3 or 4 years ago, but we are able to find them today. I mentioned that, I do third-party asset management for a deal that's literally right around the corner for this. And I would say having taken that deal over a little less than a year and a half ago, we're already starting to see some really strong improvements on the Arlington market from a rental perspective, in terms of reduced concessions, higher rent rates, easier to lease, that sort of thing. And so I really think we're coming out of the bottom of it at this point. But as I mentioned in our underwriting, we've been pretty conservative the first 2 years to reflect that. Second part of the question, if all units are remodeled, why do you think occupancy ratio is low? Do the other comparables maybe offer something more? Laundry in all units, covered parking, etc.
Yeah, I think, one thing, and I'll let you jump in here as well, Jonathan, but as you mentioned, it was higher actually prior to the lenders taking over it and stuff, and has dropped since they did, being out of state and stuff. And so sometimes it's not necessarily just um, the amenities or things that are there, but it could be the marketing that team is doing. It could be the team that they have on site, and it's not necessarily a good experience. And so I think there's a number of other aspects in there that probably has to do with the current operators. And the laundry in the units and stuff, while it's not in all of our units, it is a large percentage of the units, with the exception of, I think, the smallest one bedroom apartments. And so those are a few things I think we've seen. It was kind of similar even on Parkside, right? That we talked about. There was a noticeable thing that happened. You see occupancy drop off, and in this case, that kind of aligns with when the lender kind of took over operations. So do you have anything you want to add on that part, Jonathan?
Yeah, so you guys may have seen me looking down at my phone here. I'm looking at an email from the broker who's selling us this deal. Because obviously we were interested in this question, right? And so we asked him to go pull some data for us. So just a couple of interesting data points. So District 2308, which is our neighbor, they're literally right next to us. Same vintage, same type of property, same access point off the road. Probably their interiors are not as nice, but let's just say that they're the same for the purposes of our conversation. They're the best comp on this list, 99% occupied, currently not offering any concessions, according to the broker. I think they're probably offering some small ones, but 99% occupied. Um, 611 Lamar, over 90%, 1 month free on the second month, which to give you an idea, our underwriting is 4 to 6 weeks on concessions currently. Um, the Biltmore, 186 units right down the street, 92% occupancy right now, and doing a $200 off look-in lease concession for residents. So that just gives you a few ideas. I mentioned the deal I'm asset managing around the corners, 92%. We came up from 65 since last year. I think just kind of the final thing I would mention is that, you know, a lot of times I think people assume that all properties are just equal in a submarket and that they should all be the same, occupancy. And it's just not the case. Like apartments are a business and you have to run the business well to get results. Obviously, our neighbor is doing that because they're 99% occupied. But there's some properties that are not. And I can tell you my personal experience at Flintridge has been walking in, and as someone who they know I'm a future owner, they know that we're under contract to buy the property, having a hard time getting a hold of the staff, having a hard time getting them to help us tour units and stuff, which is frustrating, but it just shows us that I think there's some pretty low-hanging fruit in getting the occupancy back up where it needs to be. If that doesn't answer your question, feel free to pop a follow-up one in the chat. Next question. How long does the team anticipate it taking to bring property to 90% occupancy? What's occupancy level that was used to calculate your projections?
Yeah, so certainly Jonathan and Paul are, do our asset management and can speak to some of that as well. But, looking at a couple of the examples that we mentioned, Parkside, a different market, but went from sub 70 to over 90 in, I think about what were about 5 months or so,
Four
four,
months
four
flat.
months. Four
Yep.
months flat, yeah. So a little different market, but kind of shows the aggressiveness of the asset management team to do so. And then, as you, Jonathan, mentioned, the property around the corner that was a lower occupancy, and I don't know, you mentioned about a year or so that was. This one is like halfway between that as far as the occupancy and stuff. And so, do you think that those, Jonathan, probably align with our projections here as well?
Yeah, so I'm going to tell you as an investor, it's going to take 6 months. I really think we'll probably do it in less than that. But I'm going to tell you 6 months. And I would say one piece of information about the other property we've asset managed is that it's an A-class property, as in it was built 2 years ago. And so what that means is, one of the charts that Marcus showed was like our rent gap, and it showed we're several $100s below what the average person in this area can afford to rent. And that's a good thing because it means most people can afford to rent our property. And so we have a larger pool of applicants to choose from, if you will, when it comes to renters. The other property that's A class is like $1,000 over that average affordable rent or that median household income affordability gap. And so what that means is most people in the market cannot afford to lease that property. And so we had some problems leasing that. It took, about a year to go from 65 to 92. And the reason is simply most people in the submarket cannot afford to lease that property, right? But we were still able to get it over 90. It just took a little bit longer. I think something like this that's well under the rent gap, we're going to close in a handful of months. And I'm going to tell you as an investor 6 months because I think that's something that we can easily commit to. Cool. We haven't
Yeah.
had any other questions pop up yet, but Who
The
else
one, the
has?
one thing I'll just mention, I think on the second part of that, Jonathan, it said, what is the occupancy level that was used to calculate your projections? I don't know if we
Hmm,
completely answered that, but back on one of the slides, I think you'll see it's kind of it transitions from year to year, right? And so we start off, I think, with year one, like 20% um, vacancy going into like 10% vacancy to 8 or something. So that transitions as we take over the property and year to year, um, what the expectation is. I
good
do
point.
have a one that was text to me, Jonathan, someone having trouble with the chat
Lovely.
earlier and stuff. So um, one question was, why did the previous owners go bankrupt with the
Hmm.
property?
Yeah, I can take that if you want. So it's really kind of an unfortunate story. And I'm gonna mention everything. You may know some of what I'm saying, and so excuse me if you already know some of this, but just for everyone's benefit, multifamily, it kind of hit a peak in the market cycle around 2021, and started to go down. And there was really kind of a perfect storm of things that came together to cause that decline in values. And so, first of all, we had interest rates going up, which was the Fed's response to inflation that you're probably aware of just from watching the news. And higher interest rates actually push pricing down on real estate. When it's more expensive to borrow money, you can't pay as much for a property. And so it pushes prices down, which means that cap rates expand. And the second thing that happened, particularly in a market like DFW, is we had a large amount of supply, which just simply means new apartments that were brought online in the market. And so, if there's 100 apartments to a rent and there's 120 people that want to rent them, you obviously have a lot of demand, you have a lot of control. But then, if you bring 50 more units online, suddenly you have to start giving concessions and such, right? The good news in a market like DFW is that because rates have been high for 4 years now, pretty much all the construction has been delivered to the market, and there's really not an existing pipeline of construction coming to market currently. And so we're still rapidly absorbing units as the population increases, as people move to Dallas Fort Worth, as jobs increase. And so what we're expecting as owners is that, now that's going to turn around and we're going to see a pretty sharp change in terms of rent growth, in terms of occupancy. And I wouldn't say that it's been that horrible in Dallas Fort Worth. I would just say that people who 4 or 5 years ago thought we're going to get double-digit rent increases and be 99% occupied all the time were just wrong. And so, now we kind of have the real numbers to play with, and we can be conservative in our projections and then push up from there. So, does that answer the question, Marcus, or did I miss anything?
Yep. No, I think that covers that part of it.
Oh, sorry. I think I've missed the last part. Why did they go bankrupt? So,
Oh,
because rates went higher, they had floating rate debt. And so basically, if they were paying, X dollars for their debt service, they went to 2X dollars. And unfortunately, we're not able to continue funding that. It's something that we've seen on numerous properties in multifamily in the last year or two. And so that's why they went bankrupt in short.
the next part of their question, I think we answered this previously. Why is it only 78% rented? Is it in an undesirable neighborhood? So I think we kind of talked about not
Yeah, so
necessarily
I
the
live
neighborhood,
here,
but the
so
occupancy.
it's desirable enough for me. I live about a mile and a half from the property. No, it's not an undesirable area. It's mismanagement. It's because of all the things I mentioned in the previous answer, to the last question. You do have to compete for renters. So like you do have to give concessions now. We know that it's included in the underwriting. We've done it on the other asset I managed. So it's not a surprise. But if you come into this market, so the lender that's selling it to us, they live in Utah. If you come in this market, you don't know it, you don't have a property manager that knows it, and you try to run a deal, the people that live down the street are going to smoke you. And so that's literally what we've seen with this is, if you look at the financials from this property from August last year when it was foreclosed on, going back the previous year, they were doing a good job running the property. Like they did not go bankrupt because they weren't running the property well. They went bankrupt, as I mentioned, because their debt service was just too high, unfortunately. But the current lender, they can't run the property, and that's why they've given us this low of a price. That's why they've seller financed it because they need to get out and hand it over to someone that knows what they're doing.
And a final question I have over here is, I know we have this information. I don't know if I remember it off the top of my head, but from our inspection, but when was the boiler installed? They have a limited life. Is it going to need to be replaced in the next 7 years? What is the cost in today's dollars for replacement? So,
Great question. So boiler is 11 years old, as is the storage tank in the property. When we inspected it, we were told it needs routine cleaning and servicing, should last another 8 to 10 years. Obviously, if you're familiar with these kind of systems, that's not a guarantee. It's just an expectation. Storage tank probably has about 3 or 4 years left. We're going to need to replace that during our time. Fortunately, it's about a $7,000 to $8,000 replacement, so not a lot in for this kind of property. The boiler, we have a quote to replace it, and if my memory's right, it's a little under 50 grand, which is very doable with our CapEx budget if it were to go out. Whether we're using contingency money or funds from other items that we wind up not needing to replace. The expectation from the inspection is that it should last through the 7 year business plan, but if it were to not, we have the funds in order to replace it. Cool. We got a couple more. Um, so maybe you know this one, Marcus. I'm not sure if I do. For investment via self-directed IRA, what is the company name that we should indicate on the DOI? Sorry,
yeah,
what?
yeah, Jeff, that's so DOI, direction of investment. I know
Thank you.
what custodian he works with. So that's the company, the LLC name that we are creating, Jonathan, for the acquisition,
Okay.
which I don't know that off the top of my head at the moment, Jeff. I don't know if Jonathan does, but we can look that up in the operating agreement to make sure I give you the proper. I can shoot that over to you to make sure you have the proper name
It's
for
just
the
for the
deal.
LLC.
Yeah, just the LLC name.
Yeah, we can send that over to you. It's actually going to be two name or yeah, no, we can send it over to you. Yeah, we'll get it to you. Um, Another question, I can answer this quickly. What kind of roof do buildings have? How old are they? So they're, pitched roofs, shingles. Um, they don't have documentation on them, but our inspector said they're around 8 years old. There are some minor repairs we need to make on them, which are pretty typical of roofs. So think like around the chimneys, doing some resealing. Couple areas that, maybe along the edge just need to be tacked down. You know, like probably like 20, 30 grand worth of repairs across all 13 buildings, which probably sounds like a large number. It's really not for something this size. And then expectation is they should last another 10 years with these modifications, obviously barring some kind of like bad storm or something on the property. We've got an investor. If Marcus is so successful, makes so much money, why can't he pay for LASIK?
I'll share this with you, Tim. I'm not scared. I went to get LASIK once, and I actually have keratoconus, and so I was not eligible for LASIK. So there it is, live.
Cool. Anyone else have a question? Oh, it says acceptable answer. Not good answer, acceptable.
Acceptable. All right. All
He's like,
right.
well, you
Awesome.
must have saved a lot of money, so you can invest it in Flintridge.
All right. Anyone else? We'll wait just another minute or so here. And of course, if you have questions that pop up after we jump off here, I'm available. Feel free to send them over if you want to connect with Jonathan and chat about with anything. I know he'll make himself available as well. All right, a couple more that just popped in there. Let's see. The bottom one, just opened my first self-directed IRA. Can you help with filling out the investor form? Absolutely. I think I know what company you're with, and I'm pretty familiar with that. So I'll touch base with you offline and happy to help to make sure that's correct. And the other one, is there any expectation of future capital calls, and are they mandatory?
Ooh, that's a hard one, right? So go read the operating agreement for yourself. But the short answer, because we use the same operating agreement every time, is that there's always a potential for capital calls. It can happen on any deal. Our track record thus far across 10 deals through the bottom of the market cycle, et cetera, is we have not had a single capital call on any of our deals. I do everything I can to avoid capital calls. And not only that, I don't even think we've had any like GP mandatory contributions, which is something that typically I would solicit before requiring a capital call. So we have a pretty good track record, but there's no guarantee. Could always happen. If there was a capital call on the project, basically what would happen is we would send that out to you as an investor well ahead of time. We would explain our reasoning, why we're having the capital call, what it's for, why we think it benefits us as a partnership, and what the request is from you as a limited partner. You then have the option to contribute or not contribute. If you do not contribute, then your shares in the LLC in the property would be diluted pro rata. And if you do contribute, they would be kept the same. So that's the short answer. Please go read the operating agreement and confirm that for yourself.
All right, that's all I'm seeing at the moment. Wait another minute, see if another one pops in. Okay, one more via text for you, Jonathan. Being that these big items, boiler and roofs, will be at end of life in 7 years, how do you anticipate that affects the sale price?
Yeah, I like that question because it's challenging. So, um, couple of things. It really depends on the market environment that we're in. I'm going to give you a worst case scenario, which is kind of where we are now. And that is like, let's say boiler and or roof is at the end of life, and we're trying to sell, and you can't sell without, giving some kind of concession. So there's one of two things that could happen. One, we put the property on the market and we just disclose, because we're not the type of sellers that we try to hide things from people or, be shady or anything. We just disclose like, hey, roof is nearing the end of its life. You need to have funds for replacement. Then, presumably it would lower the purchase price by several $100,000, which is what it costs to replace a roof on this type of property, and or the $50,000 it requires to replace a boiler. That's option one. The other option as is that we as the general partners could front the money for said roof and or boiler, replace it, have it brand new, and then list the property on the market as being, hey, we have these upgrades and try to get top dollar for it, which is something that I have personally done. We had another roof on a property where we had a bad hailstorm. I personally fronted quite a lot of money to go replace that roof. Um, and then we were able to sell the property for top dollar. It's one of them that we went full cycle on. So, one thing I would say about this team is that across myself, Marcus, the Westline team, it's a pretty well capitalized GP team. So, we're generally able to handle those kinds of things. If something pops up that's a couple $100,000, like a roof replacement, boiler replacement, and we need to, front money in a pinch, we're easily able to do that. So that's a short answer. We'd have one of those two options, and really just kind of depends on the market that we're in. If we were in a market that's more of a seller's market from a few years ago, probably wouldn't replace it because it's not going to affect the price we're going to get, the net price. Whereas if we were in a market like today, I think we would have a serious conversation of, hey, do we want to replace the roof in order to get the best price we can?
All right. Well, I haven't seen any new questions pop in, and so I know we're just a little bit slightly over an hour here. Appreciate everyone's time and joining us in the engagement and questions. Um, so if you have any questions, like I said, after this, feel free to reach out, and or those of you that need some assistance with filling out some self-directed IRA documents or anything, I'm happy to do that as well. So I'll be in touch shortly after. All right. Thank you, everybody. I appreciate your time tonight.
Thanks, everyone.